My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a very special West Coast edition of Mad Money. Other people want to make friends, just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Most of the time when we come out here to San Francisco, we want to see the future, to marvel in wonderment at new innovations. This is not one of those times. This time we're simply trying to figure out when the losses will stop, when the blood will be staunched. We need to figure out what the heck is wrong out here, because things have changed, and they have changed for the worse. After years of terrific gains, I know what tech is doing to your portfolio. It's crushing you. Oh, you don't want these stocks anymore, right? Tech's as hated as I've seen it any time since the dot-com collapse. Has the sell-off gone too far, though? Or is this simply a rolling nightmare that's not going to end anytime soon? I mean, that's the question after a solid day, where the Dow gained 197 points, was much lower one time. S&P advanced 0.69%, and the Nasdaq climbed 0.76. It was down horribly when I got up at 2:30 here. Let me ask you something. Is this a real turn, given how low we started today? Or do you think it's just another phony, baloney bottom? That's what I'm trying to find out. Sure, there's plenty of bad stuff happening in the market. We know the Fed's going to move on Wednesday, probably hitting us with another 75 basis point rate hike. Another whopper. That hurts a ton of industries. We know that short-term interest rates have soared from practically nothing to, in the case of the 2-year, nearly 4%. Now, that's a much better deal than you can get from almost any dividend stock, especially because you're basically guaranteed to get the principal back. Very different, say, from Verizon with its 6.3% yield, or AT&T with its nearly 6.6% yield, which seems attractive until you realize that those yields keep soaring higher because the stocks won't stop going lower. After spinning off Warner Media, AT&T even cut its payout. Cut it, for heaven's sake. Hey, you know what? That never happens with treasuries. Now, we know that when the 2-year treasury note yields 4%, that's actually a good microcosm of what's happening out here. The rampant inflation is eroding the long-term value of equities. We haven't been able to stop it. Sure, commodity inflation has definitely been tamed, but not rent, not electricity, not food, not wages. That's what we're going to drill down on. That means some stocks are going to be worth less because the underlying companies make less money or become less attractive versus bonds. That's especially true for the unprofitable ones. I have been warning you against those. Hey, listen, anything that loses money for almost a year, I can't have you buy, even the good ones. I don't care how well they're really doing if they're losing money. I know the odds favor that you'll lose money if you bet on these unprofitable speculative stocks. Think of it like this. They're like when you're dealt a 16 at the blackjack table. Too low to stay, but there just aren't enough cards in the deck that will keep you from going bust if you hit. But then there's other companies, ones that make billions of dollars in profit, not revenues, profits. And those stocks now go down the way a pinball finds its way into the gutter, where you just kind of flip it away as it happens. These are the ones that we want to find out about. What the heck do they do? What do we do with them? That's what I want to know, and I've got some theories. One is that big forces are arrayed against even the best tech companies. Years ago, the smarter ones turbocharged their growth by expanding overseas. Historically, it's been a great move, but now we have an historic shock to the dollar. It just won't stop going up. If you sell $1 million worth of goods overseas, by the time you get paid in, say, euros, they're only worth $900,000. The currency translation is brutal, and there's no escaping it. That's not the fault of any individual company. It's just that the rest of the world's in even worse shape than we are. Some of the weakness is obvious. Europe's engaged in a war, the kind of large-scale conventional war that we thought was a thing of the past. It looks like just Ukraine versus Russia, but we know it isn't that. Russia's trying to force Europe's hand by cutting off access to cheap energy. The EU has a currency that looks fragile. It looks weak. Our tech companies don't make all little semiconductors that can power a watch or a camera. Some of them, especially the big ones, sell products, especially software, that cost hundreds of thousands, even millions of dollars a pop. When you don't know what your energy bill is going to be 2 times what it was last year, 3 times what it was, you hold off buying the big products, even once thought to be indispensable software as a service products. It really is that bad in Europe. I think that's a big part of what we're seeing. When you have the CEO of FedEx come on our show talking about a worldwide recession starting in China, going to Europe, and coming here, these same executives become even more reluctant to buy anything, not just tech, but anything. Who among these companies has products that can transcend this gauntlet? I bet not many. It's not like they're selling sustenance. Nobody's starving if they don't buy products from SAP or Microsoft or HP. They aren't so indispensable that you can't wait a while for an upgrade. So let's just say the first reason these stocks might be going down, the underlying companies make products that their clients can live without in an increasingly tough global economy. Second, maybe the darn Fed simply wanted these stocks to come down. Maybe that's what they want. I know it sounds punitive, but the Fed needs to see stocks come down as part of its overall fight against inflation, particularly speculative stocks. Hey, by the way, particularly the Bitcoin, the crypto, they don't want it to go higher. They want people who've left the workforce to be forced back to their jobs because their retirement savings have been crushed by a sinking stock market. They need the people who left Ford voluntarily to come back to work. They need the supply chain to get better, something that was demonstrated tonight as certainly not being fixed when Ford reported a short-term shortfall. The Fed's going to beat wage inflation by any means necessary, which means it could get uglier. Let's go back to that wacky 2-year treasury I'm talking about. What is that doing at 4%? 4%! Pretty simple. It's there because smart people are betting that the Fed won't stop at plus 75 basis points on Wednesday. They're betting on many more rate hikes until the Fed funds rate gets to where the 2-year is right now. That high rate will ultimately get tons of people back into the workforce, but admitted the wrong way, even if it causes a lot of collateral damage in the process. Third, maybe these companies have just screwed up. One of my favorites, Adobe, just spent $20 billion last week on a company that was valued at $10 billion last year. Gotta wonder if it wouldn't have been cheaper just simply to try to replicate the product rather than shelling out so much money. No wonder the shareholders don't like it. Now, I happen to think Adobe's a terrific company, but its business has been slowing. Maybe it needs this acquisition to jumpstart things. More important, though, does this terrific company with a historic growth rate north of 20%, although lower of late, really deserve to sell at less than 19 times next year's earnings? Isn't that too cheap? Do you think you'll lose money a year from now after the stock's already down more than 50% from its highs? Could the market have been that wrong when Adobe traded at $699 before the Fed decided enough is enough? Is it still too high down here at $296? This is what I'm here to find out. Most important, this is the week of Dreamforce, the celebration of all things full of promise that will help our lives. Mark Benioff, founder and co-CEO of Salesforce.com, brings tens of thousands of people together for this annual get-together, a multi-spired cathedral of learning. Will we find indispensability on the pulpit or tears in the pews as we realize that the Fed and flagging tech just can't inspire us to own stocks, at least not yet? The bottom line, this is where we find out if it's lower for longer or if it's time to recognize that what wasn't indispensable 50% ago is now valuable enough to buy after this brutal sell-off in a brutal week. I think we're getting close. But I'm going to get to the bottom of this so you can make the best decisions that you need to about your money. Let's take some calls. Let's go to Min in Connecticut. Min.
Hey, a big booyah, Jim. Listen,
I like that. I'll take a booyah. I'll tell you a San Francisco booyah. What's going on?
Yeah, well, I drive by ASML frequently, and I see constant expansion of the office space, overflowing parking lots, hiring signs outside of their building, yet the stock keeps sliding. So is this a buy, a good stock to buy, or would I be better off just buying space for a convenience store next door?
Min, here's the problem. It's a great company, but it's not a great stock. It has to get cheaper before you can buy the stock because its equipment is indispensable to make any sort of semiconductors of any higher end performance. I need to go to Paul in Colorado. Paul.
Booyah, Dr. Cramer. This is Paul from the Mile High City.
Love it. What's up?
I'd like to thank you for making me a better investor and by you staying positive through the years and helping us operate through these exceptional times.
Thank you, because I have to keep you in because this is still the greatest wealth generator. How can I help you?
Hey, my stock is RH. PE's reasonable, 11%. It's down year-to-date, 51%. My concern is it's a luxury retailer, And during the high inflation, slow economy, what are your feelings long term? Is this
look, Gary Friedman has to come on. I mean, we're out here. Gary, if you're watching, I know you're, just get over here because you've been making me feel that your stock is too high. I don't like that. You know, I love your company, 10 times earnings. I want to buy RH, but I need the high sign from you, Gary Friedman, CEO. How about Alex in Florida? Alex.
First and foremost, we got to start with a booyah.
Stutter and booyah, always welcome on the show. Thank you.
Today.
What's going on?
My father and I have been listening to you for the past 20 years. We want to thank you very much from the bottom of our hearts. I want to ask you about Uber technology.
You are key. You are crucial. How can I help?
Well, use Uber Eats quite often. It seems a little bit too easy to run the app. Worried a little bit about it. Just asking your opinion, buy, sell, or trade.
All right, $31. You know what? This is exactly what I'm worried about. Uber's losing money right now. I can't recommend the stock. I know it's going to be profitable for next year. I think 26, 25 is where I can do it. I feel so awful about that. But this is the essence of where we are at this time. I cannot get you in a stock. How about 28, 29? Because I'm very encouraged by how they're doing. But I can't get you in it right here. Right? This is where we find out if it's lower for longer, or if it's time to recognize that wasn't indispensable 50% ago, we'll talk about the stock, is now valuable enough to buy after this brutal sell-off. That really is the theme of our week. On Mad Money tonight, after a tough couple of months for the stock, could today's move in Dutch Bros be the energy the stock needs to keep moving higher? I'm checking in with the CEO. Then it's not a trip out west without a look at the future of autonomous vehicles. I'm talking to the head of General Motors' autonomous unit, Cruise, to see what innovation is in the pipeline. And from QuickBooks to MailChimp, Intuit is emerging as the champion of small business. And I'm learning more on what's ahead for the company with the company's top brass. So stay with Cramer, coming at you from San Francisco.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.